Okay, let's go.
All right, let's get right into it. Today, we're going to pull back the curtain on how the world's biggest financial players, the smart money, actually trade. We're going to cut through all the noise, forget the complicated indicators, and focus on the one core concept that truly drives the markets. So let's start with a big question. Have you ever just stared at a chart and wondered, what are the big banks really doing right now? While most of us are getting tangled up in complex systems and indicators, the institutions that literally move the markets are playing a much simpler game. And here it is. It all comes down to one thing: pure, old-fashioned supply and demand. But this isn't just some boring economic theory. No, this is the engine of the market. It's about finding where the massive imbalances are, because that's where the big institutions leave their footprints. And if you can see their footprints, you can anticipate their next move. Okay, so let's dig into the secret itself. What are we actually looking for? It's all about finding these very specific, high-probability areas on a chart where huge buying and selling decisions were made in the past. These aren't just random lines. They are precise zones where the game is being played. We call these supply and demand zones. Now, I want you to think of them as, well, as crime scenes. They're historical battlegrounds where a ton of orders were left behind. A supply zone has a boatload of selling pressure just sitting there, waiting. And a demand zone? It's packed with buying pressure. The key thing to remember is this is where the smart money has shown their hand, and they are very likely to defend that area again. So to find these zones, you first have to understand that the market is basically a light switch. It's either on or off. It's either in a state of balance, that choppy sideways price action where nobody's in control, or it's in a state of imbalance, that strong, explosive, get-out-of-the-way kind of move. Supply and demand zones are born in that exact moment the market flips from balance to imbalance. That explosion, that's our clue. All right, series cool, but let's get our hands dirty. This is where the rubber meets the road. In this section, we're going to walk through step by step exactly how you can spot these zones on any chart and draw them with real precision. This is the skill that makes it all work. So you're really just looking for 4 basic patterns. That's it. You've got 2 for reversals, where the market turns on a dime, and 2 for continuations, where the market catches its breath before continuing the trend. So a rally-based drop, for example, is a classic reversal that leaves behind a supply zone. The key to all of these is spotting its structure. A strong move, a little pause, that's the base, and then another strong move out. And drawing the zone, it's literally as easy as 1, 2, 3. Seriously. Step 1. Find that big, explosive move we talked about. Step 2, find the one single candle right before the explosion started. That's your base. And step 3, just draw a box from the absolute high to the absolute low of that base candle, wicks and all. That's it. That's your zone. Okay, so now you can find them and you can draw them. But that's only half the game, isn't it? Knowing how to trade them is what separates the chart artists from the profitable traders. This section is all about turning that analysis into action. And here it is, the million-dollar question. You've done the homework, you've marked up your chart with this perfect little zone. So now what? And the answer, believe it or not, is the hardest thing in the world for most traders. You do absolutely nothing. You wait. Here's the entire playbook. Step 1, and it's the most important. Wait for price to come back to you. Don't chase it. Step 2 is your entry. You enter as soon as price touches the edge of your zone. Step 3 is your safety net. Set your stop loss just on the other side of the box. Why? Because if price breaks through that zone, your trade idea was wrong and you get out with a small, manageable loss. Simple. And finally, step 4, where do you get out? You aim for the next opposing zone. That's a full trading plan right there. And this is the fundamental shift in mindset. Amateurs are constantly chasing price. They see a big green candle and they jump in, afraid of missing out. Professionals, we find our level, we set our trap, and we patiently wait for the market to walk right into it. That's the difference between hunting and being hunted. You ready to level up? Because, look, not all zones are created equal. Some are A+, high probability setups, and others are, frankly, junk. In this last section, we're going to talk about how to get really selective and train your eye to only focus on the absolute best opportunities. So what's the number one sign of a strong, high-quality zone? It's the exit. It's all about momentum. A great zone is created when price leaves it in a fast, violent, explosive way, usually with big, healthy-looking candles. That tells you the institutional imbalance was huge. If price just kind of slowly meanders away, that's a weak zone, probably best to just ignore it. This is the trap so many traders fall into. They become machine gunners. They see something that kinda sorta looks like a setup, and they just start firing away, taking every single trade. They're hoping one will be the big winner, but instead they just bleed their account dry with 1,000 little paper cuts. This is what you want to be. Be a sniper. A sniper is disciplined, they're patient. They might sit there for hours or even days waiting for that one perfect, high-probability shot to line up. One shot, one kill. Trading less, but trading better, that's the real path to consistency. And finally, here are 3 advanced checks you can run to really stack the odds in your favor. Think of this as your final quality control checklist. First, market structure. Are you swimming with the current or against it? Always try to trade with the dominant trend. Second, depth. You want to see price just kiss the edge of your zone and get rejected fast. If it pushes deep inside and hangs out, that's a bad sign. And third, time. A strong zone should be respected almost immediately. If price is just lingering there, the big players aren't home. Move on. So I'll leave you with this question, because it gets to the absolute core of this entire method. Are you just reacting to every little flicker on the screen, trading what you see right now? Or are you developing the discipline to wait for the levels that truly matter? The answer to that question will define your entire trading journey.